A great investment at age 30 can be a bad choice at age 60. So in this video, I will explain the best investment strategy for every age based on my 19 years of investment experience, both on Wall Street and here in Europe. I will also highlight the most common investing mistake that I see people making at every age. So let's start with your 20s. You're on your first or second job, you're making some money, but you've got to pay rent and the bills, and all you can afford to invest is maybe 50 euros a month. Building wealth this way seems slow, so you make the most common investing mistake at this age, which I also made 19 years ago when, as a young banker on Wall Street, I got into trading. Now, here's the difference between investing and trading. Investing is long-term. For example, stock investors normally hold company shares for years. And that means you benefit both if the company is profitable and it pays you a dividend, and if the company becomes more valuable, so the stock price goes up over the long term. But traders don't care about the long term. They only care what happens to the stock today. You try to make money quickly. Buy a stock at 10 a.m., sell it at 10:15, make a quick profit, and then repeat that many times. Trading promises to make you rich fast, but in reality, it's just a form of gambling. The vast majority of traders lose their money. I certainly did. So don't make this mistake. Okay, so what's the best investment strategy in your 20s? Well, first, before you buy any investments, build up a safety cushion. This is a few thousand euros that you keep in the bank for emergencies. Now, when you're young, saving up for a safety cushion can be frustrating because it can take years before you actually start investing. But it's absolutely essential that you don't skip this step. Without a safety cushion, any emergency can force you to sell your investments at a bad time, or even worse, push you into debt. Second, invest in your skills and education. In your 20s, this is just as important as buying stocks, maybe more so. This doesn't have to be a university degree. Just find courses or trainings on high-value skills in your profession, whether that's sales or negotiations or digital marketing or AI. Instead of academic knowledge, look for hands-on training that will let you increase your income within the next 12 months. And my third recommendation would be put a little money into a simple, low-cost ETF every month. An ETF is an investment fund where you put in some money and the fund buys hundreds or thousands of different stocks around the world. So this allows you to invest in the market while splitting your risk among many companies and paying very low fees. You could choose a global ETF like VWCE, or maybe a different fund that is better suited to the local tax rules in your country. In your 20s, you want to focus on building the habit while still enjoying life and building your earning power. And besides, when you're starting early, even small sums can become big money. For example, look at this simple investment calculator. Even if you only put aside 50 euros a month. Well, let's see what happens if you do this for 40 years. And let's say your profit is the same as the long-term average for the stock market, which historically has been 9% per year. Well, 40 years from now, you would have 212,000 euros. This is perhaps not enough for a great retirement, especially after you adjust for inflation, which means prices going up over time, but it is a solid base. It's a good start. Okay, so here's a quick visual summary of the do's and don'ts for investing in your 20s. Don't trade, do have a safety cushion, invest in your skills, and start buying ETFs. Now, in a minute, I will share a step-by-step training that I put together for how to start investing in ETFs. But first, let's move on to your 30s. For most people, this is the start of your high-income years. But it's also the decade where you're no longer a kid, so maybe you want to dress nicer and drive a better car and live in a nice apartment. Plus, maybe you get married and have children, and soon there are school fees and other costs to pay. This leads to the most common mistake for people in their 30s, which is failing to control expenses. For my wife and I, what worked was making a deal to keep our costs artificially low for the first few years of our marriage. Even as I got a high-paying finance job, we stayed in a tiny Soviet apartment that cost less than 200 euros a month, and we drove a beat-up old car. And in just a few years, we built some really strong savings, which today gives us a lot more freedom. I highly recommend this approach in your 30s. Push hard in your career, but keep your expenses fixed for a few years. And then start growing your expenses as life goes on, but do so more slowly than your income grows. On the investment side, here's what I recommend. First, start investing serious money. Set up an automatic transfer in your bank. As soon as your salary lands in your bank account, move at least 10 to 15% of it to your investment account. Let's go back to our calculator. Let's say you're making 2,000 euros a month and you invest 15% of that. So that would be 300 euros a month. And let's say you're 30 years old, so you're going to do this for 35 years. And maybe every year, as your income goes up with inflation, you increase the amount that you invest by 3%. If, again, you make 9% per year, then 35 years from now, you would have 1.1 million euros. And even if you are not as fortunate and the stock market only earns you 7% per year, you would still end up with over 700,000 euros. My second recommendation in your 30s is to keep your investments flexible. In many countries, it is a good idea to invest in pension funds because this allows you to claim tax benefits like refunds or reduced tax rates. If that's the case in your country, use these products. But you have to keep in mind that in most cases, pension accounts don't let you take out the money before you retire. So if that's the case, don't make the mistake of putting all your investments into pension accounts. You might need the money sooner, maybe to start a business, maybe to buy a family home. For example, I got a lot of my personal wealth through business opportunities and investment opportunities that I could not have used if everything was locked up in a pension account. My third recommendation is do passive investing. Unless you plan to become a finance professional, your 30s are not the time to read the Wall Street Journal, study company annual reports, and pick individual stocks. You will get much better results with a simple ETF strategy. Just buy and hold. If you do this right, it takes literally just 3 hours per year. And then you can use the rest of your time for more productive purposes, like improving your skills and making more money at your job or business. Okay, so here's a quick summary for your 30s. Keep your costs artificially low. Send 10 to 15% of your income automatically to your investment account. Use pension accounts for only part of your savings and save time by investing in ETFs. Now, by the way, if you're wondering how to start ETF investing here in Europe, if you've got questions like which ETFs are best to pick and what investment app you should use and how to handle your taxes, well, I've got a step-by-step training that covers all of that. It's called the Index Masterclass, and thousands of beginning investors have used it to start investing. Just follow the first link in the description to find out more. Okay, next up, your 40s. The good news is you still have a few decades until retirement, but the bad news is you will need those decades. Let's go back to our investment calculator. If I change nothing else about this scenario, but I reduce the time frame from 35 years to 25 years, then instead of ending up with over 700,000 euros, you would end up with 310,000. So it's a big reduction. And then if you keep delaying and only invest starting from age 50, so that would mean you have 15 years until retirement, your final balance would only be 111,000. So the longer you wait, the more difficult it will be to build up significant investments. So the point is, in your 40s, you better get started. Which leads me to the most common mistake among 40-somethings, which is feeling like retirement is not yet relevant to you. As one 40-something to another, let me tell you, yes, we're still young, but it is time to take action. My first recommendation is, if you're starting from scratch, you should be investing 15 to 20% of your income at least. That automated transfer to your investment account is a must-have at this age. Second, check your investment portfolio for money leaks. The two most common leaks are fees and taxes. On the fee side, don't ask your bank to invest for you. Most banks in Europe will charge you 1 to 2% of your money every year to manage your investments. And it might seem like a small amount, but over decades, this can eat up a third of your future wealth or even more. Instead of letting your bank invest for you, learn to set up your own low-cost ETF portfolio. On the tax side, one of the key things I teach my students is how to choose ETFs that work well with your local tax rules. And also, you want to make sure to use pension funds if they get good tax benefits. Okay, and my third recommendation in your 40s is keep taking risk. Now, by risk, I don't mean the chance to lose everything. I mean that your investments can go up and down a lot in the short term. Too many 40-somethings invest like 70-year-olds. You don't want to take any risk with your money. You want to stay safe, so you keep everything in a low-risk investment like bonds. Now, a bond is a loan to a company or government. And bonds can indeed be very low risk from a short-term perspective. The price will not go up and down very much. And if you lend to a solid company or government, you will almost certainly get your money back, plus some interest. But the problem is, from a long-term perspective, these kinds of investments are actually not safe at all. That's because safe bonds typically earn you very little profit. Something that seems like a safe investment in the short term can make you broke 20 or 30 years from now. So as a 40-something, you need to learn how to tolerate risk. In my personal opinion, most 40-year-olds should have most of their portfolio invested in the stock market. Yes, stock prices shoot up and down a lot, and this can be unpleasant. In a typical bad year, your portfolio might fall by 10 or 20%, which is bad enough. But in a really massive crash, like we saw during the big financial crisis, you might even lose 40 to 50% in the short term. That said, even such a massive crash is not the end of the world if you're in your 40s. That's because you've got decades of time to recover. The real challenge here is psychology. Before putting most of your money into stocks, you need to be confident that you will not panic and sell in the middle of a crash. So here's what I recommend. Read about investing history to discover how common market crashes really are. Teach yourself to fully expect market trouble instead of fearing it. Write down a clear plan of action for what you will do when the next crash happens. With this kind of solid preparation, market problems are much less scary, and you can get the full benefit of stock investing. So that covers your 40s. Don't delay investing. Put aside 15 to 20% every month. Watch out for fees and taxes, and keep taking risk. Next up, we've got your 50s. And the single biggest mistake I see among people in their 50s is thinking that you're too old to start investing. Yes, it is late, but no, it is not too late. Let's say you've got 15 years until retirement. And so maybe you can save 500 euros a month. And again, every year you increase that by 3%. And let's say you earn that moderate return of 7% per year. Well, you're going to end up with 186,000 euros. Even if you only have 10 years, so you start at age 55, you would end up with 97,000 euros. So the question is, do you want to arrive at retirement with nothing or with 100,000 or 180,000? That's a big difference, right? It's worth bothering to save and invest. Now, the way that you invest does start to change in your 50s. So here are my 3 recommendations. First, if you are starting from zero, max out your savings rate. By your 50s, your kids are probably grown up, and that should free up a good chunk of your budget. Use some of that money to travel and enjoy life, but if you've got no savings, most of it should go toward investing. Second, if your local tax rules are beneficial, really prioritize your pension accounts. In your 30s and 40s, I recommended keeping plenty of cash outside these accounts so that you have easy access for emergencies or opportunities. But in most European countries, you will get free access to these accounts as you approach retirement. So now is the time to take full advantage. The ideal solution is holding efficient investments like ETFs inside a pension wrapper. Okay, and the third recommendation for your 50s is start reducing risk gradually. Now, this does not mean sell all your stocks and switch to cash or bonds. In your 50s, you should still have most of your investments in stocks because you've got decades of investing ahead of you. But you should start adding lower risk investments like bond ETFs as the years go on. This will protect your portfolio from market crashes as you approach retirement. Now, by the time you reach age 65, your portfolio should probably be 60-40 stocks versus bonds, or maybe 50-50. So keep that goal in mind and reduce risk gradually toward it over the years. Okay, so here's the summary for your 50s. Don't think that it's too late to start investing. That is not true, but you do need to maximize your savings aggressively. Make sure to take full advantage of pension products and de-risk only gradually so that your investments have the opportunity to keep growing. Now we get to your 60s and your retirement years. The biggest mistake to watch out for here is panic selling in a market crash. As long as you're getting a monthly paycheck from your job, it is relatively easy to tolerate a stock market crash. But when you depend on your retirement account for all your income, this gets scary really fast. And this is why you need a rock-solid plan for how you will act when the market falls, because sooner or later that will happen. For a long-term ETF investor, the best approach is usually just stick to your strategy and don't make selling decisions based on the market going up or down. Now for my 3 recommendations. First, have clear withdrawal rules. You need to know exactly how much money you are allowed to take from your portfolio and when. You could start with the classic 4% withdrawal rate, where you'll calculate 4% of your portfolio at the start of retirement, and then every year you increase the amount by inflation. But in practice, a more flexible approach, which adjusts your spending to how the market is doing, is likely better. That said, the key thing is to have clear rules so you don't overspend and go broke. Second, consider locking in a minimum income by purchasing what is called an annuity. This is an insurance product where you give the insurance company a lump sum of money and they pay you a fixed sum every year for the rest of your life. No matter what happens, you will always have a predictable amount of cash coming in. This can really lower the stress level associated with the market going up and down. Just keep in mind that annuities typically don't adjust for inflation, and here in Europe, many products can be quite expensive, so you have to research this and know what you're doing. Okay, and my third recommendation in your 60s is don't underspend. You worked hard to build your retirement savings, so now enjoy them, especially in the early years of your retirement. Travel and pursue hobbies while your health is good. $1 million in the bank does little for you when you're 90 years old. Now, of course, if you aim to leave an inheritance, you should make a plan for that, working with a qualified expert. But aside from that, spend your money while the spending is good. Now, whether you are 25 or 65, the best investment that I know for amateur investors here in Europe is called an ETF. With just a few clicks, you invest your money in hundreds of different companies all around the world. So if you want to find out how to get started with ETFs, just watch this video next, where I will walk you through it step by step.